Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Julian Emanuel of Evercore writing, yesterday's CPI reinforced the 3 steps forward, 2 steps back, volatile market environment that will be a part of the road to S&P 500, 6,800 at year-end 2025. Julian joins us now for more. Julian, good morning.
Good morning.
You wrote yesterday, it's not the 1970s show. What is it?
It's 2025. And in reality, if you think about it, every asset market has been in this incredibly volatile but range-bound condition since the election, right? And so we're trying to sort through the potential for stronger growth, the potential for geopolitical shift, versus the potential for some of the policies that are being considered to be increased inflation and drags on growth. And basically, the net out of it is we're in this waiting game for further development.
Can we talk about the potential for rate hikes? How high is that bar?
Extremely high. I think there are a lot of reasons. Look, first of all, expectations are still well anchored. Okay, there's a lot of volatility around the Michigan survey. The New York Fed survey is much more stable, and the reality is that when Chairman Powell thinks about his legacy, which, you know, he's likely to be in a different position, let's say, next year, it is wrapped up in delivering the soft landing. And a rate hike would be the thing that disturbs the potential for a soft landing. And again, history will say if, in fact, inflation proves to be sticky into 2026, and we don't believe that's the case. We think this is much more like last spring, where you had several months of sticky inflation, and then the path of travel continued lower. Once again, is that, you know, the policies of the current White House would be the cause of the inflation if it were to remain sticky.
Which is the reason why you wrote there is literally no plausible scenario where the Fed hikes in 2025. I love that kind of conviction at a time where everyone else seems convictionless. Can you put into some sort of framework how much conviction you have in the 3 steps forward, 2 steps back that gives you the conviction to buy on some of the 2 steps back, because you have confidence that 3 steps forward are going to come?
Well, actually, if you think about it, first of all, look at the sentiment surveys. There's a lot of bears out there. Markets don't top when there's a lot of bears, okay? And people can say all they want about the positioning. There's still cash there. We've seen inflows. And frankly, the way this market trades, and yesterday is a perfect example, it looked like the sky was falling at 8:35. And then basically people started reassessing. And from our point of view, what was interesting is that yesterday, the things that stabilized the market were the things that actually should have been the worst performers: technology, long duration, high multiple assets, which should have been, you know, reacting badly against yields going up. Yeah. And they're secular earnings growers.
I want to pick up on what you said, which is sentiment is so bearish. A lot of people disagree with you. A lot of people say actually positioning is pretty bullish. Scott Rubner over at Goldman Sachs came out with this report where he said everyone is in the pool, including retail traders, 401k inflows, start of the year allocations, and corporates. You are everybody who comes on the show. Yeah, it's going to be volatile, but at the end of the day, buy, buy, buy. What makes you think that there's actually any bearish sentiment out there whatsoever?
Again, the moment-to-moment reactions, right? People are very quick to sell. The market bounces back because of all these reasons. And the biggest reason, which we haven't talked about, is that earnings are going to grow by 10% this year. And when you have a condition where earnings are going to grow that kind of to that kind of degree, and a Fed that, look, our base case is they still cut twice. They may not cut at all, but they're not hiking. That's okay. all of that lends itself to the idea that the bull market is not over.
You think they're going to cut twice. I have to ask about potentially this being the part of the 1970s that is reminiscent of a Fed chair that maybe is getting under a little bit of political pressure.
Look, Dan, there's no question. And I think Chair Powell was wondering whether we were replaying back to 2018 in some respects. And that's a lot of the market action, 2018. But from our perspective, the fact is, if you think about those numbers yesterday and you think about the Fed as, a two-sided risk factor, in terms of uncertainty, well, we know one thing is certain. The Fed is likely not to be relevant until June. Okay, they're just going to wait and they're going to ingest more data. And that takes one thing off the table. But again, from our point of view, we just don't think you're going to have what we've termed an uncooperative Fed, which would be a hike.
The Fed doesn't want to hike. I think we're all on the same page. We can all feel that in the communication we get from Fed officials. Bank of America indicating that if you don't want to hike, don't cut. Where are the cuts coming from? For you and the team, what delivers them?
It's again, this idea that the stickiness of inflation that we have right now is not permanent. The same way we saw it, again, continuous travel lower after several months of stickiness last year.
And how much more complicated does that picture get, though, when you have tariffs coming down the pipeline, potentially today, reciprocal tariffs line by line?
It gets a lot more complicated, and the offset to that is, I wonder if there's a bit of coincidence that the meeting between Putin and Trump that's likely to happen is happening in Saudi Arabia, ground central for setting the price of oil. And when you think about why Donald Trump was elected, is because the U.S. population has been incredibly frustrated and stressed by inflation, and he said it himself prior to the election, is that the easiest lever to pull is not the price of bacon and eggs or coffee. It is oil. And so that's the calculus.
The three biggest energy producers on the planet in the same place having talks coming very soon.
Potentially very soon. And the president just said it out there. I have been talking to a lot of people. There's been preliminary discussions about this meeting potentially in Saudi Arabia, but the president just sort of put it out there for the world. Also, next week, he is going to Saudi Arabia's Sovereign Wealth Fund's conference being handled in Miami. So there's a lot of overtures and olive branches between Riyadh and the United States, and potentially Riyadh could be that place between the Washington and Moscow.
Brent crude right now, negative 1%, 74.33. Joining us now to discuss, Nadia Martin Wiggen of Svelland Capital. Nadia, welcome to the program. Let's talk about the developments of the past 24 hours. What does it change for this energy market?
Well, right now it's brought to the forefront that discussions are underway and that the Munich meeting from the 14th to 16th of February, the pressure is on Europe to get its act together. What we see on the market side is that equity markets are already pricing in peace in Ukraine, but when we look at the commodities markets, they are not exhibiting that same type of pressure. And you can say that oil is a bit under pressure, but if we actually had the real semblance of peace, we would be trading in the low 70s, at least the bottom of the range that we've been experiencing. We'd have much lower natural gas prices. So far, the markets, in terms of the commodity traders, they don't believe it. Brent crude is still highly backwardated.
Do they not believe there'll be a peace agreement, or do they not believe that Russian energy will flow as it once did?
Well, both sides. So the first part is whether there will be a peace agreement and how quickly. It's impossible for Europe to agree on how they will handle this peace agreement before the German elections. That's in 10 days. Then they can sit and work together and try to figure out what a peace agreement would look like, most importantly in terms of enforcement. And this is part of what the Munich Security Council has to agree, because in their own notes in preparatory detail, they say they have to come up with an ironclad security guarantee that Donald Trump has said and Pete Hegseth have said does not include the U.S. on the front line. So they have to agree together. In terms of the energy side, that's what the German election is really considering as well. We have the political party, the AfD, that is much more pro-Putin than the other parties. They are willing to step away from NATO, and they would like to have that energy flowing again to make German industry more competitive. Then on the flip side, you have other parties that don't trust the Russians and believe we have to build Europe going forward. And the 5% GDP spending, that can really work on the industrial engine of Europe building these arms. But right now it's a very fragmented market. Germany creates things, Norway creates things, Norway's not even part of the EU, the UK is not part of the EU, so they really have to pull themselves together. And when we see Trump's tactics, he's being very tough on his allies and asking them to step up versus his actual adversaries. He's consistent. He's putting the pressure on Europe and going along, listening to what Putin wants. He's being very tough on Canada in terms of tariffs compared to how he's been on China, when we know his ultimate goal is to be tougher on China, and he doesn't like that relationship between Russia and Germany being so close together. He made that very clear in Trump 1.0 that he did not like this energy dependency. And Scott Bessent is in Ukraine now, showing that the U.S. is open for business. They will sell oil and gas to Europe, and they will take in exchange as a loan rare earth minerals from Ukraine. He's a transactional president, and it makes sense.
Nadia, one adversary, though, Trump has been tough on is the Iranians and the crude they ship to China. When you're looking at the oil market, how are you starting to factor in maximum pressure that we are going to see under this administration?
This is where we've really seen that playing out more on the shipping side, and Trump had a success in Trump 1.1 on being tough on the Iranians. And that's where the crude markets believe the most in the Iranian maximum pressure scenario. When we look at Russia, they are such a huge producer that Russian oil has always tended to get out somehow, even though it's in a tougher way. So on that side, we are looking at potentially a loss of 1 million barrels per day of production. But Trump also wants the Saudis to step in and produce more oil in that place. And the Saudis have this memory of Trump 1.0 when he granted a 6-month grace period for countries that were taking Iranian oil. And then the Saudis, the Russians, and the American companies brought back 2.5 million barrels per day of oil in anticipation of this outage of Iranian oil, and crude prices collapsed. So it's a much tougher negotiating tool this time to push the Saudis. Also, the Saudis have been very protective of the Russians up to now. So that relationship is very important. And it's not by accident that a meeting between Trump and Putin will probably start in Saudi Arabia.
Nadia, just real quick here, what are the chances in your view that we could get a normalization in relationship enough with European Union nations, with Russia, to allow Russian liquefied natural gas to flow once again through Ukraine into the European Union?
Well, right now, from a European perspective, what has been laid out in terms of peace sounds much more like a surrender for Ukraine. So there has to be an understanding that there will actually be a Ukraine and that it will be...
I think we've lost the connection there. That was Nadia Martin Wiggen there at Svelland Capital. Steve Ricchiuto of Mizuho joining us around a table. Steve, let's have that conversation now. Let's talk about the headlines we've just seen from the president. This is what we were expecting, reciprocal tariffs, and it comes at an interesting time. It comes at a time where we just had hotter than expected CPI. So let's start with CPI. What was concerning about that print for you?
Well, the continuous period, the extended period at which the core CPI numbers are running on the hotter side on a year-over-year basis, and everyone's always looking for a base effect to roll off, or everyone looks for an excuse for an individual component of the report to drive the report. The reality is this is an index for a reason, because it has to include lots of components. And when you look at a lot of the line item components, they can't even be seasonally adjusted. So we have to aggregate them in order to seasonally adjust it, because they are very, very volatile. And ignoring something because it's volatile is just an inappropriate way to deal with monetary policy. It's an inappropriate way to deal with economics, to be honest with you.
So step one, let's accept the data. You're accepting the data for what it is. Step two, let's incorporate something into the outlook. A change in policy, tariffs. What's the contribution of these tariffs going to be in the months to come?
Again, this is a difficult component because the dollar is firm. and the global economy is particularly weak. You look at the response of China to the tariffs that Donald Trump has imposed, again, the additional 10% tariffs. It's a very, very muted response back. And I think it reflects the fact that there is a global excess supply of tradable goods. And as a result of COVID, we've diversified supply chains. We have more excess supply of tradable goods than we've ever had before. So there is offsetting pressures. So I don't think you can say, well, we bumped this component up, therefore we're going to bump this up in the inflation component. You have to look at the fact that margins are going to be squeezed.
When it comes to these tariffs, do you think they will be passed on to the consumer, at least a one-off hit?
It's possible. It's not definite. And it really depends on how tight the labor market is, whether the consumer matters or it bothers the consumer. Understand, what really took Joe Biden down, in my assessment, is not inflation. It was the level of prices. Moreover, it was the level of price and the fact that real disposable income was squeezed under the Biden administration. So if you're in an environment where prices are going up but your income is going up and your purchasing power is actually expanded, do you mind? The answer is probably not. And that's the end game that I think this administration is going for.
Take it one step further. Bank of America came out and said the dollar may not like tariffs after all, even though the dollar's been on a tear because of these tariff threats. Because of full retaliation, the dollar could weaken. How vulnerable do you think the U.S. is to retaliation?
I think the global economy being as weak as it is reduces the ability of people to respond back. Again, we are the buyer of last resort. And so, therefore, there is a certain amount of power that is imposed or implied by that. And the administration is pushing that envelope. There's no doubt about that. How long can they push it? How far can they push it? They're going to attempt to find out. But you have to understand, the Federal Reserve is pushing the envelope as well. The chairman continuously talks about the fact that he believes monetary policy is restrictive. Yet he began cutting rates when the economy was running above trend. He began cutting rates when inflation was running well above the Fed's target. So was policy really restrictive? And now we're in a situation where policy is actually more accommodative.
Julian Emanuel was on the show about 50 minutes ago, and he had written, there is literally no plausible scenario where the Fed hikes in 2025. Do you agree?
There is a plausible scenario. There isn't necessarily a statistically viable scenario, okay? What I think you need to get the Fed to hike rates in 2025 is the unemployment rate to move significantly below 4. Put 3.8 at, because once you get back to 3.8, you've basically taken all of the uptick in the unemployment rate that they responded to in cutting rates out of the equation. So therefore, they don't have that argument anymore. Then you take the 10-year note and say, if the 10-year note pushes above 5, then guess what? Their argument that inflation expectations are anchored goes away. Then you have a reason. So you have a necessary condition, the unemployment rate. You have a sufficient condition, the 10-year note. You're not going to get the 10-year note unless you get the unemployment rate. That's the key thing to watch. If the unemployment rate starts to move down and significantly below 4, the markets will jump the gun and price it in.
You know, when inflation expectations bottomed in the last 12 months, middle of September, what happened in the middle of September? Fed started cutting interest rates.
You know what Fed Chair Jay Powell said yesterday? He said that the reason why is not because of inflation expectations. He actually said that the increase in yields was due to other concerns, which I thought was very interesting, sort of discounting the argument that was implicit in what you just said.
What do you make of that? Is he giving a nod to politics? Were we thinking about that in the middle of September?
He's saying it's not my fault. Don't look at me.
Adam Posen of the Peterson Institute joins us in about 60 minutes. I think he might have a different view on things. Steve Ricchiuto from Zero. Steve, it's good to see you, sir. Cheers. As always, thank you. Andrew Hollenhorst of Citi. Andrew, you've had in the books for a while that you expect the Federal Reserve will reduce interest rates this year. I believe you think it's going to happen now sometime later on in the spring, around May time. How does this CPI number of yesterday and PPI this morning help your case?
Yeah, this definitely still is all in the column of the Fed is not in a hurry to reduce interest rates. That's what we've heard from Chair Powell. That's what we saw at the January FOMC meeting and in congressional testimony. So they're going to need to see some more evidence that inflation is cooling. I think they will get some of that in the PCE reading. Now, you want to be careful here. We have CPI, we have PCE, we have year on year, we have 3 month. You can look at all these different metrics on inflation. When you dig down into the details, the fact that shelter inflation is slowing down, I think that is going to give Fed officials confidence that we're getting some slowing. In terms of what this PPI number means, I think part of the reason the market is reluctant to react is you really have to look at these detailed categories and how they're going to play into that PCE reading that I think is going to be softer than the CPI reading we saw yesterday.
Well, Andrew, let's try and stay on the details then. When you think about the sources of inflation, energy, labour, goods, services, what do you think the source of disinflation will be through the next year or so?
I think the single biggest factor that is causing me to be confident, and I think will cause Fed officials to be confident that inflation is slowing, is a slowdown in shelter prices. Again, even though we saw a stronger overall reading for CPI inflation, we saw shelter prices that were slower yesterday. And if you look at what was strong in the CPI reading, it was really things like motor vehicle insurance, used car prices. These are more volatile categories and categories that don't get, in some cases, as high a weight in the PCE reading. So I think we'll see some volatility in CPI, but that through line, as Chicago Fed President Goolsbee would say, is still lower in inflation.
What would you have to see, Andrew, to change your view that maybe this is something that's a bit stickier?
Yeah, so what would be concerning is if you saw just a lot of residual strength in wages and in services prices. Now, we still have somewhat elevated wage growth, but it looks to be cooling. We know the labor market has softened, maybe it's kind of stabilized more recently, but softened before stabilizing. That should all mean that we get a glide down in wages, we get a glide down in services price pressure. If we're wrong about that and you were to see wage growth that was actually picking up again, that's where I would get concerned. That's where I think Fed officials would get concerned.
And it's the reason why that was the number that people looked at in the jobs report, the payrolls report that we got last Friday, although it was explained away by the hours worked going down. I am curious about which aspects people are honing in on that are not necessarily inflationary. When you have fairly broad-based inflationary pressure, people had theorized that you would get this disinflation in services that was enough to offset a reinflation in goods. It doesn't seem like that's happening to the same degree that people previously expected. Why do you dismiss that?
Well, I think shelter services are on track. The non-shelter services, that is where we should be concerned. And again, it's this whole issue of wage pressure, labor markets, and does that bubble up into services prices? We saw that again in the January reading, this what we call residual seasonality, where people increase prices at the beginning of the year, and they increase prices by more at the beginning of the year, and we get these really strong January readings. So I'm really looking to see not just in the January inflation number, but what do we see in February, what do we see in March? I think those services prices are going to cool again in February and March. They were cooler in November and December. So if you put together, 5 out of 6 months that's cooler there, and you have wages that are slowing, that's a pretty good picture for the Fed. We have to watch these next couple of reports.
Andrew, today's the big one, apparently, reciprocal tariffs. We've had this conversation about inflation without talking much about trade. Now, Andrew, you've got as a baseline interest rate reductions for 2025. How do you think about tariffs and the potential feed through into higher prices? We've got 10% on China. We could have more still to come.
Yeah, so the details are what are really going to matter here, and we don't know the details. I do expect we're going to get some kind of broad-based tariff. That's been pretty core to the Trump administration messaging, to their economic policy. They need that both for incentives to produce in the U.S. as well as to raise revenue. The question is, are there any carve-outs to those tariffs? Are we including Canada and Mexico? That's almost 30% of trade if you include or exclude Canada and Mexico, so that makes a big difference. Also, are there carve-outs for certain products? That can make a big difference because some products you would expect those tariffs to be almost fully passed through into consumer prices. Most products you would expect those tariffs would not be fully passed through. So the inflationary effect will be less the more you get carve-outs and the more you focus on those products where you get less pass-through. If the inflationary impetus is not too great, then I think Fed officials can say it's a one-time price level increase. It's not an inflationary pressure issue. The challenge for the Fed is going to be if inflation is not otherwise slowing, can you say that? So I think you need inflation to be slowing down just by basic macroeconomic dynamics. Then you need these tariffs to not be too great an extent. Then you will get a limited Fed reaction.
Andrew, that sounds a lot like transitory. And that argument's not a good one these days, even if they think it's the right one. You saw back in the middle of September that inflation expectations bottomed, at least market perception of inflation expectations. Andrew, the Fed chair, as Lisa pointed out, Chairman Powell kind of pushed back at the idea that they contributed to higher inflation expectations with 100 basis points of rate reductions. Andrew, can I get your thoughts on that just to wrap up? Do you think they did contribute to higher inflation expectations?
I think it wasn't so much the Fed rate cuts. I think it's more the expectation of tariffs. We see that in the consumer surveys where people say they're worried that prices on durable goods are going to go up. So I would see that as more tariff related. And it's the short-term expectations, one-year expectations, not the long-term expectations that Fed officials would worry about more.
Andrew, appreciate it. Thank you, sir. Andrew Hollenhorst there of Citi.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.